Welcome to the Ontario Mortgage and Real Estate Insights podcast, where we cover the daily developments, trends, and regulatory changes affecting the industry. I'm your host, Steve Hamoan, and today we're diving into some exciting news that could change the way you handle your residential real estate transactions in Ontario. We're kicking off today's episode with a groundbreaking new service that's set to revolutionize the residential real estate closing process in Ontario. Weclose, a new legal service founded by Michael Wills, is here to simplify your home buying, selling, and refinancing experiences with transparent fixed-rate pricing and professional legal support. Launched in August 2024, Weclose is already making waves across the province by offering a seamless and stress-free way to finalize residential real estate transactions. Whether you prefer in-person consultations or virtual appointments, Weclose is designed to meet the needs of today's fast-paced real estate market. Michael Wills, the founder of Weclose, has over 25 years of legal experience and is a partner at a prominent Ontario law firm. He says, "As a legal team, we are committed to making the residential closing process simple, transparent, and affordable. Whether our clients are buying, selling, or refinancing, we handle all the legal details so they don't have to." So, what makes Weclose stand out? For starters, they offer fixed-rate pricing, ensuring you know exactly what to expect from the get-go. From your first consultation to the final signing, the Weclose team of seasoned residential real estate professionals manages all aspects of the legal process. You can receive instant online quotes, book appointments, and access secure digital tools for document sharing and e-signatures. Key features of Weclose include comprehensive residential real estate services that cover home purchases, sales, and refinancing. The focus is on clarity and ease, so you won't be caught off guard by hidden fees or unexpected costs. With expert legal support, all your inquiries and concerns are directly addressed by Ontario-based real estate lawyers. Flexibility is another cornerstone of Weclose's services. They offer both in-person and virtual consultations to accommodate your needs. The process is streamlined and meticulously managed to minimize delays and reduce complexity. This makes Weclose a trusted partner for real estate professionals, helping to build long-term relationships with agents and brokers by providing consistent, high-quality service. Michael Wills adds, "Our goal is to simplify the complex legal process of real estate closings. Weclose delivers a smooth and hassle-free experience, backed by years of experience and cutting-edge digital tools." Based in southwestern Ontario, Weclose is uniquely positioned to serve clients throughout the entire province. By leveraging modern online platforms and secure technology, Weclose enables you to access legal services wherever you are. This makes it easier than ever to finalize your real estate transactions without unnecessary stress or confusion. Whether you're a first-time homebuyer, refinancing a mortgage, or selling property, Weclose ensures you have access to experienced legal professionals who prioritize transparency, accuracy, and personal attention. For more information or to receive an instant quote, visit weclose.law. Next up, we're discussing the dominance of big banks in Canada and how challengers are trying to make inroads. It's not easy going up against Canada's banking oligopoly, but some are trying. Challengers like EQ Bank and Wealthsimple are rolling out new and cheaper offerings, growing their base and gaining brand recognition. But experts say that rather than creating a disruptive threat to the big banks, mid-sized players are more likely to be bought up by the majors. Claire Sellerier, Canada Research Chair in Household Finance at the University of Toronto's Rotman School of Management, says, "The banking market in Canada is not known to be very competitive. It's not going to improve." She expects more consolidation ahead. This outlook comes after RBC closed its $13.5 billion takeover of HSBC Canada in March, while National Bank is in the midst of buying Canadian Western Bank in a $5 billion deal. The loss of these mid-sized players in what was already a small pool of competitors to the big six banks leaves few others with enough scale to even distract the majors. Wealthsimple is emerging as one, after reporting this past week that it has more than $50 billion in assets, more than double from last year and more than 7 times what it had 5 years ago. The growth seen with the firm's business model has led Chief Executive Michael Katchen to declare that Wealthsimple is the first and only credible alternative to the big banks in Canada. The fintech company's low fees are a central draw, offering no commission trading and low investment management rates as part of a growing suite of products as it tries to fill a void of competition. When you take out the mid-range players, you make it even more less competitive. And I think the way that shows up is Canadians suffer when it comes to fees, said Kachin. The big banks maintain the sector is intensely competitive, especially on areas like mortgage rates. But consultancy North Economics estimated in March that Canadians pay more than $7 billion a year in excess fees. This rough estimate was made by comparing financial results at Canada's Big Five banks to those in the United Kingdom and Australia, where charges on accounts, overdrafts, ATM withdrawals, and the like are much cheaper or free. Consumers in countries like the United Kingdom benefit from aggressive regulators that have put in measures like making account switching easier by putting the onus on banks to move all payment data and other information over to a new account. There's little sign of such switching ease coming to Canada, so competitors like EQ Bank are instead focusing on getting consumers to switch gradually. We're trying to make that seem like a low-risk activity for somebody, so you can open a bank account while keeping your other bank account open, said Chief Executive Andrew Moore. The bank pays higher interest rates on accounts where a customer has switched over their payroll, which can provide an anchor, he said. EQ has also rolled out new products like its Notice Savings account launched in June, which pays out higher interest rates when consumers agree to give at least 10 or 30 days notice of a withdrawal, and just this last week it launched a bank account targeted specifically at small businesses. The nice thing about being a medium-sized bank, it's much easier to think about bringing that kind of product innovation to the market, said Moore. The bank's efforts have led to its assets roughly doubling in the last 5 years to some $54 billion. The jumps in size at Wealthsimple and EQ are in contrast to some other smaller players like Laurentian Bank, which has seen its assets grow 7% to $47.5 billion in the same time. Laurentian has been working on a turnaround, including numerous executive shuffles, the selling off of business lines, and other restructurings, but analysts are still skeptical of how much traction the bank can get, even if it solves its operational issues. It's not clear what Laurentian Bank's structural advantage and competitive advantage will be at the end of all this, said Vertius Corporation analyst Nigel D'Souza. It's not the only one struggling to see much growth. Manulife Bank has grown around 11% to $30 billion since 2019, and ATB Financial is up some 14% to $62 billion. Canadian Western Bank was seeing higher growth, up 38% to $42.5 billion, but of course, it's being bought up. In the cooperative world, Desjardins has managed to grow around 43% to $444 billion, not too far behind National Bank, the smallest of the big six, at $454 billion. Meanwhile, RBC, the country's largest publicly traded company, has about $2.08 trillion in assets. While some of the smaller banks are doing better than others, they all face the challenge of it being more expensive to raise money, in part through paying out those higher interest rates to attract deposits, said D'Souza. They also have to keep more capital on hand because they're seen as less stable. Perceptions of stability can also make it harder to convince people to park more cash at the bank than the $100,000 that's federally insured, though Wealthsimple has gotten around this by partnering with several banks to offer upwards of $500,000 in insured deposits. The overall hesitations on stability, however, along with other barriers like a lack of a branch network, limited economies of scale, and less diversification, mean it will always be hard for mid-sized players to gain market share, said D'Souza. Our view has always been that there's going to be more consolidation within the Canadian banking space because the larger banks have structural competitive advantages. The consolidation could in its own way lead to lower fees, he said, as banks benefit from more economies of scale. Canada's banking sector is already quite competitive on lending rates, he said. And while a concentrated financial industry is something especially notable in Canada, it is part of a broader long-term trend, said Claire Salarier. Banking markets are more and more concentrated, and this is the case more or less everywhere. Our final topic for today covers some major headlines from the past week that could have significant impacts on the mortgage and real estate landscape in Canada. Let's start with the news from TD Bank. Toronto Dominion Bank, or TD Bank, announced that its current Chief Executive Officer, Bharat Masrani, will be retiring. Raymond Chun, who is currently the head of Canadian Personal Banking, will take over as Chief Executive Officer at the company's next annual general meeting in April. This move comes after Mr. Masrani has been in the role for a decade, which is typical for Canadian bank CEOs. Raymond Chun's rise through the ranks has been rapid. He joined TD's top executive team just 3 years ago in 2021. This news comes after months of speculation that Mr. Masrani might step down in response to TD's money laundering scandal in the United States. It's a significant leadership change for one of Canada's largest banks, and it will be interesting to see how Mr. Chun steers the ship. Moving on to another big headline, Rogers Communications Inc. has announced that it is buying BCE's 37.5% stake in Maple Leaf Sports and Entertainment, or MLSE, for $4.7 billion. This deal would give Rogers 75% ownership of the sports conglomerate that owns several major sports teams, including the NHL's Maple Leafs, NBA's Raptors, CFL's Argonauts, and MLS's Toronto FC. The transaction values MLSE at $12.5 billion, setting a new high-water mark for the price of Canadian sports franchises. BCE's chief executive officer, Mirko Bibic, was under pressure to pay down $39 billion in debt, which led to the sale of this prized asset. This is a significant move for Rogers, cementing its position as a major player in the sports and entertainment sector. Lastly, let's talk about the new mortgage rules announced by Ottawa, aimed at making home buying more attainable for young Canadians. Starting December 15th, the price cap for insured mortgages will increase to $1.5 million, up from $1 million. First-time homebuyers will also be allowed to take out an insured mortgage with a 30-year amortization for all types of homes. Additionally, more buyers will be eligible to take out an insured mortgage with a 30-year amortization on a pre-construction home. These new policies are seen as an attempt by the Trudeau government to win over young voters who have been priced out of home ownership due to high prices and higher interest rates. Industry experts have already noted that the announcement is attracting prospective buyers back into the market. This is the first significant relaxation of Canada's mortgage rules in over a decade. As these new rules come into effect, it will be interesting to see how they impact the real estate market across Canada. Will we see a surge in first-time homebuyers? Will the higher price cap make a significant difference in high-cost areas like Toronto and Vancouver? Only time will tell. That's it for today's episode of Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussions on Weclose, the dominance of big banks in Canada, and these latest business headlines insightful. I'm your host, Steve Hamoan, and as always, thank you for tuning in. Until next time, take care and stay informed.